Question 61. Which of the following derivative contracts most likely expose the contract owner to default risk? We've got swaps, futures, or options. So for futures and options, I think we've gone through this before, but these are going to be exchange traded. And so there's not default risk because the clearing firm that you're trading the futures or options through is going to be the counterparty to you technically, and they are taking on the risk of default. And so they're basically guaranteeing that your transaction will go through when you buy and sell futures and options through them. So there's no default risk in those cases. In the case of swaps, these are going to be traded over the counter. So rather than trading through some central clearing firm, you're going to be directly going under contract with another party. And so that other party, whether it's another institution or bank or whatever, they could technically default. So there is potential default risk in swaps, but not in futures and options. Answer A. Question 62. Consider a put option with a premium of $5 and a strike price of $20. The maximum possible loss for the writer of the put is closest to. So if I'm the writer of a put, essentially what I'm contractually obligated to do if I get exercised is I have to buy the stock at the strike price. So if the stock falls below $20, the buyer of that put is going to basically sell me the stock at $20. So I'm buying the stock at $20, and then they're selling at 20 and buying below. I'm doing the opposite. So in this case, I'm having to buy the stock at $20. The max possible loss then is if the stock goes to zero. So we've got 20 minus 0 there. However, I did earn a premium of $5. And so our max possible loss is just going to be 20 minus that 5, which gives us 15. Answer B. Question 63. Which of the following is least likely correct regarding digital assets? So least likely, so 2 of these will be correct and 1 will not be. A, exist as data on a network. We can rule that out since that's going to be true, or that will be correct. Digital asset does exist as data on a network. B, cannot represent physical assets. I'm going to say that's probably going to be our answer so far. It can represent physical assets, and this is essentially what tokenization is. It could represent ownership in real estate or some other physical assets like art. And then lastly, C may be characterized as a swap, depending on its design, use, and function. I think we can rule this out too, since the term digital assets is pretty broad and flexible, and it could be set up like a swap in theory. Answer B. Question 64. An investor has a cash investment of $15,000 with a periodic rate of return of 7%. He borrowed an additional $5,000 at a periodic rate of 2% to increase his investment size. The leveraged rate of return for the period is closest to. So let's pull in the formula we're going to use for that. And so what this is going to look like is the amount earned minus the borrowing cost. And then we're going to divide that by the equity, and that's going to give us our basically the return, including the amount that we borrowed and then subtracting out the cost of that. So the amount that we earned is going to be our full investment with our own funds plus the borrowed funds times the rate of return. So 0.07 times 20,000, which is 1,400. And then our borrowing cost is going to be pretty straightforward. It's going to be that 5,000 and then multiplied by 2%. So we get $100. And so coming back up to the original formula, amount earned 1,400 minus 100 divided by our equity gives us 0.0867. Which is going to round closest to answer B, 8.6% return. Question 65. Gamma Short Hedge Fund had $50 million in capital at the beginning of 2016. Management fees based on assets under management using end of period, and incentive fees 2% and 20% are 2% and 20% respectively. In 2016, Gamma Short had a 14% return. Hurdle rate is 7%, and the incentive fee is based on returns above the hurdle rate. Assuming that the performance fee is calculated net of management fee, meaning management fee is taken out, then we calculate performance fee. Then the investor's net return for the year 2016 is closest to. So to get that net return, we basically are going to use this 50 million beginning of the year value, and then we need to find out what the end of year value is net of all the fees, and then we can calculate that return. So calculating those fees first. So management fees, pretty straightforward. It's end of period amount. So we're going to take that 50 million, multiply it by the 14% return, and then multiply it by the management fee of 2%. Gives us management fees of about 1.1 million. And then that incentive fee is going to have that hurdle rate of 7%. So we're going to earn 20% of the profits over 7%. So we're going to take 50 million times 0.14 minus 0.07 to give us the amount of profit that we earned above the hurdle. And then from there, we have to subtract out the management fee since we are net of management fee on the incentive performance fee calculation. And then multiply that by the performance fee lastly of 0.2. So that gives us 472,000 for that fee. So our after fee AUM is going to be the starting value multiplied by our return of 1.14 or 14%, and then subtracting out those fees. So we end up with about 55.38 million. So that net of fee return now is pretty straightforward. We take that ending value, after fee AUM is how I labeled it, divide by the beginning AUM, 50 million, and then subtract 1 gives us 10.78, which is going to be answer C. Question 66. European put and call options on GHG stock both have an exercise price of $50 that expires in 120 days. The underlying asset is priced at $52 and makes no cash payments during the option's life. The risk-free rate is 4.5%. If the put is selling for $380, the call's price should be closest to. So we're going to be using put call parity to calculate this, and I think we're pretty much given all the inputs. So we're going to have exercise price, time to expiration, underlying price, put price, risk-free rate. We're going to be using all these variables here. So let's pull in that put call parity, which is going to be underlying plus put equals call plus the risk-free bond component, essentially, is what this is. So we need to bring this over to the other side, and then we can plug everything in and solve for it. So essentially what we get is 52 as our strike, or as our underlying, the current price, 380 for that put price. So we add those together, and then the kind of big variable here is going to be X as strike price, and that's going to be discounted back at 1 plus the risk-free rate to the T. And our T is going to be 120 days divided by 365. So it's like about a third, since it's 1/3 of the year. And when we do out all that math, we end up with a call price of 6.518, which rounds up right here to answer A, $6.52. Question 67. A hedge fund has a beginning year value of 370 million and a 2+20 fee structure with no hurdle rate or watermark. The fund calculates the management fees using end of period assets under management and incentive fees net of management fees. If the ending value of the fund is 40 million, then the total fee of this hedge fund for the period is closest to. All right, so this should be a pretty straightforward calculation. We're given end of period value at 400 million. We're going to just multiply that by 0.02 to get our management fee. So we get a management fee of $8 million. And then for the incentive fee, we're going to be taking that net of management fees. So right off the bat, we're going to subtract that out of our profit. So we get 400 million minus 8 million management fees. So then we're down to 392. So then we get 370 million subtracted from that, and that makes our profits net of fees, net of management fees of $22 million. And then from there, we'll multiply that by our 20 fee structure, which is 20% of all profits, since we have no hurdle rate. So it's just going to be on all those profits. So we get an incentive fee of 4.4 million. So our total fee is just going to be these two things added up. 4.4 million plus 8 million gives us 12.4 million. Answer A. Question 68. Which of the following expressions most likely refer to the non-monetary benefits of holding an asset? So non-monetary benefits of holding an asset. A, cost of carry, B, convenience cost, or C, convenience yield. So looking at the wording of these right off the bat, I think we can rule out A and B since we've got costs. If these are benefits, then we wouldn't want to have costs associated with those. So we can rule out A and B right away, and we're going to go with the answer C, convenience yield. And essentially, convenience yield is kind of the benefits of holding the asset versus the futures contract. So if you looked at something like oil as an example, if you're a energy company that needs to hedge, it's helpful to maybe use oil futures and whatnot. But at the same time, if you need to ramp up production or do other things that require you to have the physical oil, that convenience yield is that benefit of holding the oil versus the futures contract. So that's going to be convenience yield. Answer C. Question 69. Luna Babbage is an investor who has invested $150,000 each in the hedge funds ART and EDD. At the beginning of the calendar year, both funds have a 2 and 10 fee structure, which is 2% management fee, 10% incentive fee, with management incentive fees paid at the end of the year. Incentive fee is calculated based on returns above a 6% hurdle rate, net of management fees for both funds. At the end of the calendar year, the value of ART appreciates by 10%, while that of EDD depreciates by 4%. The incentive fee paid to the management of ART is closest to. So our incentive fees, since incentive fees are calculated based on returns above the 6% hurdle and net of management fees, we do need to still go ahead and calculate that management fee right off the bat. So our management fee is going to be $150,000 times 1.1 since it's end of period and our return was 10%. Where did it say that? They're paid at the end of the year. So then we're going to multiply that by 2%, gives us $3,300 is what the fee will pay. So then our incentive fee, we're going to have to subtract this out to get that. So the profit above our hurdle rate of 6% is going to be 10% minus 6% times 150,000. And then we need to subtract out that 3,300 to get the net of management fee, incentive fee, and then multiplying that by the 10% fee structure or incentive fee on profits. Which gives us $270, which is going to line up right here with answer A. Question 70. The table below illustrates details concerning otherwise identical call and put options on a U.S. small cap stock. So we got the call and the put here and some metrics. So time to expiration, exercise, option price, volatility, type, and risk-free rate. Holding everything else constant, which of the following changes will most likely increase the value of the option in question? So we've got A, decreasing the volatility of the call option. So regardless of whether it's a call or a put, decreasing the volatility is going to mean that it's less likely to end up in the money. And so if it's less likely to end up in the money, it's going to decrease the value of it. So we can rule out A. B, decreasing the exercise price of the put option. So decreasing the exercise price on a put option is going to make that put option more out of the money since we want the price to be higher for our put to be more in the money. If a put is more out of the money, then it's going to be worth less since it's less likely that the option is going to be in the money at the end of the period. And then C, increasing the time to expiration of the put option. Increasing time to expiration in either case, call or put, is going to increase the value of the option. Again, I think it's helpful to think of these in terms of what makes it more likely to end up in the money versus out of the money. If you have more time, then it's more likely that that option is going to potentially end up in the money because there's just more time for more things to happen. So thinking about these in terms of the probability to go in the money, decreasing vol means less likely. Decreasing the option price means less likely. And then increasing time going to be more likely. Answer C.